Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about what a 529 plan is, how 529 plans work, and some alternatives to 529 plans like whole life insurance. Let's get started. A 529 plan is a tax-advantaged savings plan designed to help pay for education. Originally, it was limited to higher education costs, but later was expanded to cover kindergarten through 12th grade education at the end of 2017 through the Tax Cuts and Jobs Act. The two types of 529 plans are savings plans and prepaid tuition plans. Savings plans grow tax-deferred and withdrawals are tax-free if they're used for qualified education expenses. Prepaid tuition plans allow the account owner to pay for tuition in advance at current rates at certain colleges and universities since tuition generally increases every year. There are also a couple alternatives to 529 plans which all have different benefits than what 529 plans can offer and a couple of drawbacks too. The 529 savings plan is the most commonly known. 529s have become popular because of the high contribution limits, but the contributions are not tax deductible against federal income tax. Some states do offer tax credits or tax deductions depending on the plan you choose. Each state has their own 529 plan with various investment options within each. 529 plans are mostly limited to a variety of mutual funds. As far as contributing money into a 529 plan, there are no limits on how much can be contributed to a 529 account each year, but some states put a cap on the total contribution, which recently ranges from $235,000 to over $500,000. A unique feature of a 529 savings plan is that you can front load it with 5 years worth of contributions in the first year instead of contributing to it every year. Keep in mind any contributions within the 5-year period over $75,000 for single gifts or $150,000 for joint gifts could be subject to federal income tax. Going over the annual gift tax exemption of $15,000 per parent will likely trigger gift taxes, so you want to avoid that. You aren't restricted to investing in your own state's 529 plan, but doing so may get you a tax break, so check your in-state plan first if you just can't pass on the additional state tax deduction. If you're willing to let go of a tax break, some states allow non-residents to invest in their plans, such as Alaska, that might offer different or more appealing investment choices. 529 plans grow tax deferred until withdrawn and are exempt from federal and state income taxes as long as the money is used for qualified education expenses. Any other withdrawals are subject to taxes plus a 10% penalty, with exceptions only for death or disability. Theoretically, since after-tax money is contributed into the plan and assuming that money is used to pay for college, some other form of higher education, or even kindergarten through 12th grade, then the distributions or withdrawals from a 529 are not taxed on either federal or state income taxes. When the funds are distributed for kindergarten through 12th grade education costs, tax-free withdrawals are limited to $10,000 per year. Overfunding the plan is one of the major disadvantages along with limitations when it comes to transferring or using the funds on education only. If you can't transfer the beneficiary to someone else in your immediate family, then you can always cash in the account, pay the taxes and 10% penalty as a final option. That would be an option if your child were to get a scholarship of some kind, or decides not to go to college at all, or drop out somewhere along the way. The taxes and penalty only apply to the earnings, not the original principal that was contributed into the 529 plan. As far as the impact to FAFSA and financial aid, the balance in 529s are considered parental assets and only up to 5.64% is counted against expected family contribution. Other items to note are the earlier you start a 529 savings plan, similar to any kind of investing, the more time there is to compound returns and growth, especially when front-loading with 5 years worth of contributions. With a prepaid tuition plan, you'll generally be able to lock in a lower tuition rate, since many schools raise their prices every year. Prepaid tuition plans do not cover kindergarten through 12th grade and only apply to higher education, which is a significant difference between the 529 savings plan and the prepaid tuition plan. Prepaid tuition plans grow in value over time, just like 529 savings plans, and the future distributions to pay for tuition is not taxable. 529 savings plans can cover room and board expenses, but a prepaid tuition plan does not cover room and board. Prepaid tuition plans typically have other restrictions like limitations of which colleges and states may accept prepaid tuition plans, In contrast, within a 529 savings plan, the money can be used at just about any eligible higher education institution. Typically, prepaid tuition plans may work for students who are extremely likely to go to an in-state university, since in-state schools tend to favor their residents. Currently, there are only 9 states that offer prepaid tuition plans, and those states are Florida, Maryland, Massachusetts, Michigan, Mississippi, Nevada, Pennsylvania, Texas, and Washington. There are several alternatives to 529 plans that you may not have thought about, and some that were created specifically for gifting. The ones I'll go over would be whole life insurance, Roth IRAs, Coverdell education savings accounts, and UGMA and UTMA accounts. Whole life insurance can be used because of the cash value accumulation that whole life offers. There are no investment options to worry about like in a typical 529 plan or other investment vehicles, since there are minimum guarantees for both cash value and death benefit within whole life insurance, as long as annual premiums are paid on time and the policy does not lapse. When structuring a whole life policy to be used in the future to help pay for college, the whole life policy should be purchased within 1 to 3 years after the child is born and have annual premiums that end after 10 to 15 years, so that the cash value can grow until a child would typically attend college at around 17 to 18 years old. 17 to 18 years later, the cash value growth should have increased enough to pay for 4 years of school, assuming at least $8,000 to $15,000 of premium was paid into the policy per year. This would mean a 10-pay whole life policy would likely be the best fit for this purpose to balance front-loading premiums similar to a 529 plan, provide life insurance coverage on one of the parents in case anything happened to them, and college would be funded through the death benefit instead of the cash value. In a way, it's a self-fulfilling plan in the sense that college would be funded whether that parent is alive through cash value loans or through the death benefit if they passed away. When taking out a loan against the cash value, it does not specifically need to be used for education costs or any specific purpose, so there is flexibility in case your needs change in the future. It really does not have any significant drawbacks, but you would need to go through underwriting and a medical exam to be approved for a policy. Paying for the policy would be somewhat similar to contributing to a 529 plan anyway, and if it's not that important to receive tax credits or tax deductions on the contributions, then whole life offers flexibility in using the cash value and provides death benefit coverage on one of the parents. If you and your family can afford to do so, buying 2 whole life policies, one on each parent, would provide full death benefit coverage, but it's something to think about. My last point to note on whole life: look for mutual life insurance companies that typically offer non-guaranteed dividends on their whole life policies, like New York Life, Mass Mutual, Guardian, and Northwestern Mutual. Ask your financial advisor or insurance agent about whole life insurance whether you intend to use it as an alternative or supplement to a 529 plan or not to protect your family. Although Roth IRAs are intended for retirement saving, they can be used for college planning too. You won't get any tax deduction and your contributions count towards your income, but the Roth IRA will grow tax-free and your withdrawals will be tax-free with no restrictions on how the money will be used, as long as you're age 59 and a half or older and have had the Roth IRA for at least 5 years. Otherwise, you'll have to pay taxes and generally a 10% penalty. When withdrawing contributions from your Roth IRA, they would not be impacted by taxes and can be withdrawn at any time. Roth IRA balances are not counted as assets like they would be in a 529 plan when applying for financial aid through FAFSA. There is nothing holding you back from having both a Roth IRA and a 529 plan, as long as your annual income fits within the 2021 guidelines of $140,000 for single filers or $208,000 for joint filers. There are 2 drawbacks for using a Roth IRA for education. The first is the limited annual contributions of $6,000 or $7,000 if you're older than 50 based on 2021 tax guidelines, and the second is that it limits how much you have for your own retirement. A Coverdell education savings account can offer a wider array of investment options than most 529 savings plans, like individual stocks. Coverdells can also be used to pay for kindergarten through 12th grade and higher education. That's just about where the benefits stop, at least in my opinion, because there are 3 big drawbacks that I need to point out. and those would be that the contribution limit is exceedingly low at only $2,000 per year, which over an 18-year period will barely be able to pay for even 1 to 2 years of college by that time, even if you include some growth, since tuition only seems to increase each year. On top of the annual contribution limit, there is an income limit, and as of 2020 is $110,000 for single filers and $220,000 for married couples filing jointly. And lastly, the money contributed into a Coverdell isn't eligible for any tax deduction or tax credits like in a 529 plan. The scope of families and students this is ideal for is pretty narrow, and largely the cons outweigh the pros. Uniform Gift to Minors Act and Uniform Transfers to Minors Act do not provide the tax benefits of 529 plans, but similar to a Coverdell, there are more investment options and the funds can be used outside of just education costs. However, the money is in the child's name and therefore 20% of the balance counts against them on the expected family contribution on the FAFSA when applying for financial aid. Contributions into these accounts don't allow for tax credits or tax deductions, and the growth is taxable like in a brokerage account. There really aren't many benefits to these accounts since they can lower the financial aid received and offer no tax benefits at all. The only benefits are there is no limit on contributions and there is flexibility in how the money can be used, which does not need to be education. Here's a summary of all the options I mentioned. With either a Coverdell or UGMA UTMA, even though they offer more investment options beyond just mutual funds, since there are no tax benefits and have other restrictions and impacts to financial aid, it largely seems like it would be better to save and invest money in a regular non-qualified brokerage account instead. Overall, if you live in one of the 9 eligible states and expect your child to go to an in-state university, then a prepaid tuition plan might be suitable. 529 savings plans are the most versatile option to consider given the tax benefits, high contribution limits, and limited FAFSA impact. Also consider buying a whole life insurance policy for insurance coverage as well as cash value to potentially fund education or supplement your own retirement in the future. Out of the options I mentioned, I'd say that some combination of a whole life policy and a 529 savings plan would be a pretty good option for most families in terms of specifically saving for education costs and college tuition. But talk to your financial advisor about what options are truly best for your situation. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did. And please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.